All right, there we go. Awesome. Well, thank you everybody again. Welcome, welcome, welcome to our onboarding training week one. Um, Thank you again for coming out on a Tuesday night. I know you're some rolling all day long, okay? So today we're going to explore how life insurance can be a powerful tool for building wealth and securing your financial freedom. All right. We're going to address some common misconceptions, highlight some strategies used by financial experts, and provide some actionable insights. So, despite living in one of the wealthiest nations, financial literacy does remain a challenge. So, here in the United States, about 95% of people will end up financially insecure. That is largely due to just financial miseducation. Sometimes we just don't know what we don't know, right? So today we're going to tackle this by addressing some of these gaps, but we're going to be emphasizing specifically where life insurance fits into a wealth building strategy, because that's kind of what we do here, right? So we'll give a little bit of context. Now, most of you sort of know me, but that's okay. Let me catch everybody up. All right. I'm Leah D. Lynch. I'm executive director here at Experior. I am based in historic Newcastle, Delaware. Um, I've been in this industry for a little too long now, over a decade, and I have managed to figure out how to leverage these insurance tools to achieve this financial independence. So the mission today, folks, is to share some strategies that work so we can help you secure your financial future and set up your clients and family and friends and all that to do that as well. So let's go and jump right on in here, okay? All right. So let's just start with the basic. What is insurance, right? So we're either licensed agents here or we're trying to get our license. This is just a basic concept. Anybody, you can either come off of mute or just write in the chat. What is the definition of insurance? Doesn't matter whether it's car, auto, life, whatever.
Transfer of risk.
Transfer of risk.
Transfer of risk.
Absolutely. Yep. That's going to be on the question number 2 on the test, right? All right. So insurance is the transfer of risk. Okay. It's a unilateral contract. That means it's a one-sided agreement where the insurance company promises to pay a policyholder if a certain event occurs. Okay. But the policyholder doesn't necessarily have to, they're not obligated to take the benefits. It's really important in light of everything that's been happening to our friends and family out there in California, in the last couple of weeks with those fires and stuff like that. Okay. So insurance, this transfer of risk is a big deal. Okay. Participation in the group affords you protection when things go badly. So, sometimes people want to give insurance a bad name, but when you need it, you need it. So don't be cheap. Okay. Don't be cheap when it comes to insurance for yourself or for your clients. So we're gonna start looking at life insurance in particular because that's kind of what we focus on here. So life insurance can be a versatile financial instrument. Okay, there's basically two types. We've got term insurance, which is going to be temporary coverage, where the premiums go solely towards your coverage. All right. And then there's permanent insurance. That's going to combine your death benefit with cash value. Okay, both going to remain active as long as your premiums are paid. The temporary, you don't get a chance to pay the premiums forever. It's a shorter thing. Let's kind of break this down a little bit. All right. So term insurance, which includes group plans, like employer provided plans, credit unions, stuff like that. And then there's going to be individual plans that are privately owned. All right. So think about term insurance like renting an apartment. Okay. So you can rent a luxury apartment on Central Park West and get to see all the views and all that for pennies on the dollar. Okay. It's not designed to last forever. You use it while it's useful to you. And when it no longer serves its purpose, everybody gets to walk away free and clear, no harm, no foul. Right? All right. Then we got permanent insurance. So for purposes of our discussion today, that's going to be options like final expense, whole life, index universal life. Okay, they're all going to offer different various levels of flexibility and benefits, and we're going to dig a little deeper into those. Okay, so let's talk a little bit more about group here for a minute, because you're going to come across people with group insurance all the time. All right, So like I said, group insurance is a flavor of term insurance. It's just the term is the term of your active employment. Okay, it has a lot of great perks, like the costs are really low. I mean, sometimes it's free. All right. And we have guaranteed insurability. So that means when you become a part of that group, whether it's, your job and you go through whatever your probationary period is, or, you join the credit union or whatever. Okay. Once you're eligible for coverage, you're covered. Okay. But there's some significant drawbacks to group insurance, not the least of which is the fact that when you have group insurance, you have absolutely no control over that policy. Okay. The group owner can cancel it, they can raise it, they can lower it, they can do anything they want to because you have no control over that policy. Okay. Then we've also got the situation where, again, the coverage is going to end when your employment ends. And what a lot of people don't realize is that for group policies, the fine print, that's the term of your active employment. So that means that if something happens and you go on leave or you get terminated or you're on medical leave or you're on disability or something like that, guess what? You're not covered during those times because you're not actively employed. So you literally have to work until the day you die for group insurance to pay out. All right. Now, don't get me wrong, there's a place for group insurance. Okay, I never tell clients not to take advantage of it if it's being offered to them, but everybody needs to understand that you got to look at that as bonus. Okay. It can't be your bread and butter. It can be the gravy. It can be the icing, but it can't be the cake. Okay. You're not going to have any benefits while you're alive. And like I said, you literally have to work until the day you die for it to pay out. So that's group. Just know where it fits. Okay. Then we're going to look at the rest of term. So all the discussions for the rest of today is policies that are not group. Okay. So term is by far the most popular choice due to the fact that it's got lower costs, right? And you have access to living benefits. So when you see the ad on the TV, you can get $1 million worth of coverage for $20 a month. That's term insurance. It's always the lowest price per thousand. Okay. So understand that that's what it is. With the term insurance, we do start to get some living benefits coming in here. But the whole point of term is that the coverage is temporary. Remember, 100% of your premiums are going to go towards a death benefit. So for a level term, whether it's 10, 15, 20, 30 years or whatever, the rate's going to be locked in at for a particular period of time, the time of the term. And then when that initial rate lock period is up, usually you can renew them for a certain amount of time, but the price is going to catch up to however old you are. So the 20 years elapse, 30 years elapse, you have to go through medical again, but the price is going to jump like really, really big. Okay. And it's going to keep going up after that until it expires. And depending on how long the people in your family live, you may or may not have coverage at the end of your life. Okay. So again, there's definitely a place for term when you've got clients that are, just getting started out or money's kind of tight and they got a lot of stuff going on in their world that is just expensive, kids, mortgages, cars, college. I mean, what happens if the primary breadwinner is not there? How do they sustain their way of life? There's definitely a place for term. Okay. But people have to understand what they're getting. Okay. Because only about 2% of terms pay out. So that means that either the people are outliving the term or that once it comes out of that rate lock period, it's not uncommon for a 30-year term for the prices to go up 2.5, 3, 4 times what they originally were. So when those prices start jumping up, at some point, people just kind of cry uncle and walk away. Okay, so term is good if that's the stage of life that you're in, but people just need to understand what they're paying for so that they don't get to the end and they're like, I put all that money and I get nothing out. And I'm like, well, you get what you pay for. All right. Now, let's look at, now we're going to move over to indexed universal life. So we're looking at permanent coverage. Okay. So again, permanent coverage is going to include final expense and whole life. All right. We're going to focus a lot on IUL today because it's such a powerful tool. But no, final expense is going to run anywhere between $4,000 and $50,000. And it's exactly what it sounds like. It lasts as long as your person lasts, and it's designed to cover those end of life expenses. Pretty easy. It accumulates some cash value at a super conservative rate, but they got to keep paying it for the rest of their life. Okay. Whole life lasts your whole life. That's the easy way to remember that. Okay. And depending on the age and the health of the client when they go through underwriting, those values can go like way up super, super high. Okay. But today we're going to talk about, I'm going to talk here a little about Index Universal Life. It's a super attractive option. It's got higher returns than like a traditional whole life policy. The returns are going to be linked with market growth. It's flexible, and we've got these tax-free gains. All right. Like terms and living benefits. All right. And we get this protection against market losses that make it super appealing. Okay. The difficult thing about IUL, similar to term, is that you do have to go through a health physical. All right. So a lot of times I get my agents that are asking me that are new to this. They're like, well, when do I do an IUL? When do I do a term? All right. That's a complicated answer. But remember that under the bottom, the IUL and the term are riding, it's like a car. They're riding on the same chassis. Okay. So if you got a wheel and the struts and the frame of the car, and you got two cars like that, the term policy is going to be a Prius. Okay. The IUL policy is going to be a Porsche. So if the underlying underwriting is exactly the same, so if a person can qualify for a term medically, chances are they can qualify for an IUL. So if all the underlying underneath covers is pretty much the same, and it turns out that they can actually afford an IUL, and the features of the IUL fit what they need, why would we not make that option available to them? And the answer is that a lot of times people aren't comfortable putting them together. So we got to learn how to work the IULs. Okay. So the hard part about an IUL, let me go over here and give you a little bit. Sorry, I should have done this one here. Okay. Is that we've got all these wonderful benefits of the IULs. You know, you got tax-free growth, we got compounding, liquidity, protection from your creditors. We're using indexing. So we got that safeguard against market downturns. You know, we like to call, you know, we'll talk about indexing in a minute, but zeros are here. One of the biggest downsides to the IUL is that most people don't understand it. They go out on Google University, see if they can figure it out. They decide that it's too good to be true, and sometimes they won't even look at it. So I'm here to tell you that it's not too good to be true. And who says it's not too good to be true? The IRS says it's not too good to be true. All right? So IRS code 7702, tax code, allows certain life insurance policies to accumulate tax-free cash value. This is going to give us a significant advantage. So we use these tax-free loans against the policy when it's needed. All right. But it's super important that we structure these policies properly, that we fund them properly, and that we represent them accurately. So whereas an IUL is definitely a powerful tool that can be used during retirement and for cash flow purposes, an IUL is not an investment. Okay. It is an insurance policy first and foremost. So it's important for us to structure the policies properly and make our clients understand how to fund them properly so that they don't flip over to being a modified endowment contract. That's what we're talking about when you hear us saying we don't want to mech it out. We don't want to mech it out. Okay. If you fund it, if you overfund it the wrong, you know, you pay too much in, it turns into an investment, and then you lose all the tax benefits. So if we're going to be looking at IULs, part of our education process is we need to learn about IULs, a little more details. Okay. So now we got the basics of life insurance underneath our belt. So as we prepare for life's journey and we help our clients do the same, the question is always, does your financial portfolio cover all of your needs? All right. So we've got to incorporate tools that are going to protect and grow our wealth, especially for long-term security. So let's kind of look and say, all right, let's kind of look and see what's a good way to look at this. So in my experience, success leaves clues, right? So if you're trying to learn how to do something, you want to look at somebody who's already doing it the right way. So if we want to be financially successful, we need to look and see what financially successful people do. So everybody knows who Warren Buffett is, right? Or you should. Okay. So Warren Buffett has these 10 principles of financially successful people. So what we're going to do for the rest of this presentation is we're going to look at what Warren Buffett does to grow his empire. And then we're going to stack it up against a financial portfolio and see how they match out. Okay? So in a nutshell, Warren says, protect your capital and prioritize your liquidity. Understand the power of compound interest and avoid excessive taxation. Plan for inflation and unexpected critical illnesses, which are the leading cause of financial distress. So we're going to take these principles and we're going to dig into them a little bit deeper as we move forward. But let's just kind of lay a little groundwork on our financial portfolio first. Okay? So when you look at this slide here, financial portfolios, there's a lot of tools that we can use to acquire and accumulate wealth. They basically fall in these three buckets. Okay, so we've got short-term liquidity and savings, long-term growth and investments, and then income protection and guaranteed benefit kind of tools. Or a diversified portfolio is going to include elements out of all three buckets. Okay, and then we've got to combine these in a balanced way that ensures both growth and stability, especially during life's uncertain times. Okay? So what we're going to do moving forward is we're going to start to take all of these different tools. So we recognize these tools, checking accounts, savings accounts, 401s, life insurance, that's what we do here, right? IRAs. So we're going to take these tools and we're going to line them up and see how they do versus what Mr. Buffett says that we should be paying attention to. All right? So let's look at this first principle. His first principle is make money, but never lose money. Okay? And then principle 2 says, don't forget principle number 1. Okay? So, like I said, Warren Buffett, this is one of his most famous rules. It emphasizes the importance of being conservative and careful with our investments. Okay? Because avoiding loss is a critical principle in building wealth. Because recovering from those losses requires a significantly higher return. So let's pause here and think about wealth management in general. There's 3 basic phases to wealth management. Most people think about the accumulation phase. That's early on. You know, we're working, doing as much as we can, trying to put as much money as we can. We're trying to grow our nest egg, right? And get that up as big as we can. So that when we get in that distribution phase, that's when it's time to reap the rewards of all of our work, right? Start drawing this money out. But hopefully it looks like retirement, right? But what people don't focus on a lot of time is a phase that's in between. That's called the protection phase. All right. So typically the protection phase should be anywhere from 10 to 15 years prior to when you're planning on retire and starting to pull money out. All right. So when we're going through and looking at money and how it grows and how it did not grow, we got to remember that the closer we get into retirement, in that phase where we're starting to draw our money back down, we have to be more careful. We have to protect our gains because if something happens, we don't have time to get it back. Okay? When you're that close to retirement, time is not on our side. All right, so you think to yourself, okay, he says, make money but never lose money. Well, how are we going to keep from losing money? All right, let's take a minute and look at the 3 ways that money actually grows. There's 3 basic ways. All right. So we have the fixed model, a variable growth model, and an indexed growth model. So fixed growth is going to be where there's a conservative level of interest that's paid. It's usually tied to the principal, but it never changes. Okay. So think about a CD or a bond. Okay. It's not going to be earning a whole lot of money, but it's steady. It's conservative. It's safe. Okay. That's fixed growth. Probably not going to retire on that, but at least you don't lose no money. All right. Then we look at variable growth. So variable growth is going to ride this roller coaster up and down. Okay, the stock market is a good example of variable growth. If you're kind of playing around in Bitcoin right now, that goes up and down, right? One day it's worth something, one day it's not, up and down. So you ride the roller coaster. All right. So the stock market is the best example of variable growth that I can point out to you. Everybody sort of knows how that works. So let's pause here and take an example, because a lot of people who don't mess around the stock market don't really understand what's happening. So we're going to take an example, and let's assume that you have a $100,000 portfolio, just for easy math, right? And you come in Monday morning and you turn on the news and you find out that the stock market has dropped 50%. Oh my God. Okay. So now you're all upset, heart palpitating, not a whole lot you can do about that. Maybe have a drink, go to bed, hope it's going to get a little better. All right. Then you get up Tuesday morning and you find out, hallelujah, the market has bounced back 50%. Woo, 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 woo. Okay. So when the market drops 50%, your $100,000 portfolio goes down. Then the market bounces back 50%, so your portfolio is going to go back up. So who's going to tell me what the value of your $100,000 portfolio is on Tuesday morning after the market tanked and then bounced? Is it still $100,000 or is it different? There we go.
Different.
75,000.
Yes.
That's right. Okay. Absolutely. Because we're looking at our base value. So if my portfolio is worth $100,000 and it dropped 50%, that's $50,000. So 100 minus 50 is 50. Okay. Now we're at 50 and then it gains 50%. Well, half of 50 is only 25. So 50 plus 25 is $75,000. So when you're talking to people and trying to make them understand why it's so important to not ride this roller coaster, especially close to when they're trying to retire, this is a good example because it shows that in order to get back to where we started from, the market's got to pretty much double the bad thing that happened to make up for the thing that's coming to the top. That's why Warren Buffett says protect yourself from the losses. Okay? Then let's look at indexed growth. So the IUL is the best example of indexed growth. But I am going to take a minute here and slow down and explain to you guys how indexing gets credited to a person's account. Because I don't think I did this the other weeks. Okay. So indexed growth, first of all, variable growth, we're in the stock market, S&P 500 or whatever, NASDAQ. Okay. It's going up and down. When we have something that's an index, we pay attention to what's happening in the market, but the money's not actually in the market. So think about it as being market adjacent. All right. So the way that money is credited in an indexing model is what's called a point-to-point crediting system. So that point-to-point can be a year, 2 years, 5 years, just depends on the policy that you look at, the product that you're looking at. Okay. But let's just look at this here. So you're going to be able to take advantage of the market gains, which are protected from the losses. So if we did a 1 year point-to-point crediting model, and today is January 21st, 2025, we would look, say we're using the S&P 500 index and just say the value is 10, just a random number. Okay, we're going to look and see what the value of that index is on January 21st of 2026, regardless of what happened along the way. So we don't got to ride the roller coaster. Okay, we're going to look at it a year apart and say, is it up? Is it down? Is it the same? If it's up, then we get to credit those gains to the value of our account. If it's down, we're protected from those losses. So we just kind of stay pat. We don't lose any money. Okay, then next year, we start another point-to-point. So point B, which is January 21st of 2026, now becomes our new point A, and we're going to look out and see what happens over the next year. Okay, so that's how the growth gets credited into the account like this. So point A to point B, see what happened. Then look in the next period, and the next period, and the next period. All right, if there are losses, we're protected from the losses. If there are gains, then we're allowed to take part in the gains. So that's how index crediting works in an account. All right. So we like to say 0 is our hero because it can go up, but at least you can't get zapped too much. All right. So the IUL is the perfect example of indexing in action. So we already talked about all the advantages of an IUL, right? Tax-free loans, take advantage of market growth, get protected from market downfall. So we're going to look here and see the difference between a variable growth model and an indexed growth model. So when you're looking at this chart, everything that's here we're going to use the S&P 500 as an index right now. So everything in the blue columns over here is stuff that's participating in the market. Okay, mutual funds, 401ks, IRAs, 403bs. Okay, and then over here in these two green columns is the index IUL. So the IUL in this particular example has a 15% cap and a 0.75% floor. So some IULs have a 0% floor and some actually do a little better. Okay, the cap on an IUL is the maximum amount of growth that can be accredited to that account value during that particular crediting period. So when you look back here, 1997, 98, 99, the market is balling, money is flying, everybody's rolling, buying old big old houses and everything. And our $100,000, we're looking at the same $100,000, it's growing. Wow, 3 years went from 100,000 up to almost $200,000 in 3 years. All right, right? Then we get over here in the IUL that's got that 15% cap on it. So no matter how good the market does, we can only credit it with 15%. That's what the cap means. All right. Then 2000, these 3 years over here, we get this mixed bag of losses that's going on. So you can see the money that looked like it was in the account at the end of 99 is starting to get clawed back. A little less, right? But over here in the IUL, we're protected from the loss. So and this one's actually earned a little bit of money. So there's not a lot going on, but at least we're not losing no money. This is the protection from the loss, right? Next few years, we get this mixed bag of growth. On the years where the growth is more than 15%, the IUL is restricted to the 15% growth. On the years when the growth is less than 15%, then the IUL and the variable are going to kind of be able to credit all the same amount of credits. Then we get down here to 2008, where everything just kind of crashed and the market dropped almost 40%. So, oh my God, can you imagine if you were, or a family member or somebody was very close to retirement in 2008, ready to retire within 5 years of retiring, and they wake up overnight and pretty much 40% of their life's accumulation is gone overnight. So if all of their money was tied up in the variable marketplace, do you think that some of them were able to retire? Or if they did, some of them still working, right? Is their retirement what they thought that it was going to be? So if all their money was tied up in the variable markets, chances are no. That's a huge hit there. Okay, so you can follow this the rest of the way down through, and you can see up and down as we're crediting the different things here. When you get to the end of the 20-year period, because we're looking at 97 to the beginning of 2017, our $100,000 in the variable market has grown up a little over $300,000. Not too bad. But wait, the IRS is coming to get their piece. All right, we got to pay them $90,000. So you're going to net a little over $200,000. So our investment doubled, in that 20-year period, give or take. Now, for the IUL, on the other hand, that was protected from the market losses, we started with 100,000, and because we never had to take those dips and try to come back up again, that portfolio now is worth over $500,000. Okay? And guess what? I told you that money is accessible in the form of tax-free loans, as long as it's taken out in the form of a loan. So there's no taxes that have to be paid on it. So you actually get to net the $500,000. All right? And then guess what? There's even better news than that. We have IULs now that don't actually have any caps. So can you imagine how much more the IUL would have gained if we were able to credit it with more than the 15% in those years when the market did better than 15%. Okay? This shows the power of indexing and the power of the IUL. Okay? But as agents, we have to learn how to structure these policies properly so that our clients can take full advantage. And then we have to transfer the knowledge to them, because if they don't know how to use their policy, then it's kind of a waste, right? So zero's our hero. All right, let's move on. We did 1 and 2. Let's move to principle number 3, management versus no management fees. Okay, this principle aligns with the basic advice of financial educators like John Bogle, who's the founder of Vanguard. He always advocates for low-cost index investing. So what that means is high management fees can erode your investment returns over time. So remember, I said your portfolio's got to have a balance between those 3 different buckets. Okay, so we got to have some stuff that's in that bucket. A lot of stuff near the middle of this chart here is in that in the bucket number 2. All right, but a lot of these carry some very high management fees and some loads. So when your clients are opting for these options, especially when they're in that accumulation phase and they're being a little bit more aggressive in their investments, they need to choose the ones that have the lowest fees and the lowest loads. Okay. Next principle, number 4, inflation is 3%. So you notice that's kind of like a statement, right? And this is just a common financial principle. Every economic and financial advisor is on board. We all know what inflation is, right? So inflation reduces the purchasing power of your money over time. So if you're going to be smart, you got to choose investments that are going to give you a return that's higher than the inflation rate in order to just kind of break even and tread water. All right? So there's basically a couple different levels of inflation. One's called core inflation. That doesn't count like volatile stuff like food and energy. The other one's called headline inflation. That's like everything, all consumer spending. The core one is a longer term one. But back in November 2024, to give you a point of reference, the headline inflation rate was 2.7%, and the core inflation rate was 3.3%. So this 3 is kind of like an average, okay? But when you're looking at your clients and we're doing all of this evaluation, a lot of them are going to want to be like super conservative and hold their money. Look at what's happening here in your checking account. If you're sitting around and you're leaving $20,000, $30,000 sitting around your checking account or whatever constitutes a bunch of money to you, okay, it's literally, the last time I checked, the interest rate on my checking account was somewhere around 0. Okay? So I feel good because my balance looks good. But the truth is, if I'm leaving a lot of money tied up in a vehicle that isn't even keeping up with inflation, every single year, the money that's sitting in that account is worth less. So you have to keep inflation in the back of your mind. All right? Let's keep going. All right. Avoid double taxation. So this is just a core principle in all tax-efficient investment strategies. So double taxation can happen when income is taxed at the corporate level, and then they tax it again at the individual level. So think about you doing your taxes, and you get a statement from the bank telling you what your interest was for last year. Or maybe you sold a stock, and you made money on stock, right? They're going to let you know what the gain was on the stock. All right? So you're going to get taxed on that as well. So anything that is any gain that you're making from money that was originally taxed before you made the investment, that's double taxation. Okay, so we want to kind of, that's where the Roth IRAs and the Roth 401ks kind of come in, because you're paying the taxes on the front end, so you don't got to pay the taxes as much on the back end. But you just got to actively look for things that don't have those. Okay, so this is one where the IUL is really a workhorse in this area, because the money that's in the IUL is growing and you don't pay taxes on it. So even though you're using after-tax money to put the money into the IUL, every time it grows, you're not paying taxes on all the growth. That's why the IUL is so powerful. Okay? Well, lots of reasons, but that's one of them. All right, let's look at number 6. Okay, flexibility and liquidity. So this is also one of the basic principles in tax-efficient investment strategies. So flexibility specifically refers to whether or not your money can adjust to what life is happening. Okay, so if you put your money, you choose investment vehicles that tie your money up in a little box where the money can only get used for like one or two things. Say like a 529 college fund. Sounds like a great idea. Like what happens if your kid doesn't go to college, right? What happens to the money? Okay, so flexibility is whether or not you're going to be able to use the money for whatever you need to use it for. Okay, liquidity is more a measure of how easy can I get to my money when I need it. So there's an inverse relationship, in my experience, between liquidity and the amount of interest that an institution will pay you for having the money. So look at the checking account. It's flexible, it's liquid. You can pull your money in and out of your checking account as many times as you want, but they ain't paying you no interest on it because you can pull it in and out anytime you want. Okay, but it is important to be able to make sure that we can actually get to our money when we need it and use it for what we need to use it for. And guess what? With an IUL, through those tax-free loans, you can get at the money when you need it, assuming you've accumulated some cash in there, and you can use it for wherever it needs to get used for. All right, let's talk about compound interest. Okay, so compound interest is super important. All right, so the idea of being able to have the money earn money on itself. So you guys can see here, we're going to kind of hold on this concept here for a minute. So I'm going to go to another slide, but you guys can see here where the FIAs and the life insurance fit into the compound interest, right? These other ones, maybe, maybe not, just sort of depends. All right. So let's look and see, talk a little bit about compound interest versus simple interest. All right. So the simple interest is just going to only based on the principal amount. Remember I said like a CD or a bond or whatever. The compound interest, the interest is earning money. You're earning interest on the interest. Okay, so in the case of an IUL, when we're stepping up through that crediting mechanism, we've got our initial amount. We go through a period where there's some growth. We attribute the growth to the account. That becomes the new base. We move to the next period. If we have more growth, that growth is going to get attributed based on that new value. And then we keep leveling up and we level up and we level up. Okay, so compound interest allows our money to grow exponentially instead of in a slow, linear fashion. So when it comes to compound interest, Albert Einstein is the guy. Okay, so Albert Einstein says that compound interest is the eighth wonder of the world. He who understands it earns it, and he who doesn't pays it. Okay, we're in financial services here. We're trying to help people learn how to win the money game, right? So are we going to win the money game and learn how to use compound interest to our advantage and pass this information on to our clients? Or are we going to get gained? You either pay it or you earn it. All right. So I'm going to look here really quickly about how compounding looks. Okay. So let's just look here. Again, we're using $100,000 and 10% because that's easy math. We got our calculators going up in here. Okay. So if we look at year one, year one, year two, simple interest here on the left, compound interest on the right, it looked about the same to me. There ain't a whole lot of stuff going on up there. Okay. But then when you start jumping down here in years 5, I can see a little difference. Year 10, I'm like, all right, we can do that. Right. When you get up to years 20, 30, 40, look at the difference between the simple interest model and the compound interest model. Okay. We go from a little bit here to this is like $500,000 on simple interest and $4.5 million on compound interest. Oh my God. All right. So we need time. The time value of money, it's got to grow on your side. So when we are working on things and we've done a lot of trainings, you'll hear a lot about the $1 million baby here. Okay. The $1 million baby is basically illustrating the time value of money and compounding. It's like basically on steroids because we're taking this IUL policy that we can write on as young as a 14-day-old child and putting that money in place and giving it time to really, really get to cranking. Okay. And then we're funding it in a way that the cash is accumulating as fast as possible. I love me some $1 Million Baby. All right. And that's a very, very good way to get into a household and understand what's going on and help them for real. All right. So I just want you guys to be aware of something called the rule of 72. Einstein kind of set this up, and he's kind of a smart guy, right? I don't know about you, but I'm not carrying a calculator around all the time. And a lot of times people try to wonder, okay, how's this compounding work and how fast does it build up? So the rule of 72 basically says that if you take the number 72 and you divide it by the interest rate that you're getting paid in a whole number, that tells you about how much time in years it takes for that money to double. So if you look at $10,000 here, okay, 4% interest, 72 divided by 4 equals 18. Okay, so it's going to take about 18 years for this $10,000 to double to $20,000. Then another 18 years for the 20,000 to double to 40,000. All right, so this is so you can ballpark how the compounding can kind of work to your advantage or against you if you pay interest charges. All right, when you get up to 6%, you see the number of years goes down. 8, 12%. So this is the rule of 72. Just be aware that it's out there, it's powerful, and it's a way to do the easy math to kind of see how powerful the compounding can be for us. All right, let's keep it moving here. Let's keep it moving. We're going to look at principle number 8, Social Security. We all know Social Security. That's our government finance program, right? Okay. Warren Buffett tells us that we really need to understand how Social Security benefit works, how the benefits work, including like the best time to claim your money. Okay. It's definitely essential in our retirement planning. But most people don't realize that Social Security was never, ever, ever designed to sustain us in retirement. It's only supposed to be about maybe 40% of your pre-retirement earnings. I don't know about you, but I can't live on 40% of what I make. Okay. So, and how much that's actually going to turn out to be is going to depend on a bunch of factors like how long did you work and how much money did you make and when did you decide to claim your benefits? All these things are going to factor in there. So that's to say, if we know that Social Security is not going to be enough to sustain our people, who do you want to be responsible for figuring out what the supplemental situation is going to be? It's got to be us. We got to be the goose that's controlling the golden egg, right? And when I look at my children and my nieces and nephews, they're in their late, early mid-20s, early 30s. I don't even know Social Security going to be around by the time they're putting in. They may never get a dime out of that. Okay? So we don't know how that's going to manifest itself. So we got to put people in a position in ourselves where we are controlling what's happening in our future. So understand Social Security. Let's go to principle number 9. We're almost done. We're doing real good here. Okay. So critical and chronic illness is the number one cause of poverty and bankruptcy. This is really important in insurance and healthcare policy contexts. All right. So basically, intuitively, you know that medical emergencies and chronic illnesses can lead to financial ruin, right? Without the right insurance. So like I was saying at the beginning on the insurance slide, there's a whole lot of different insurances out there. Don't be cheap when it comes to insurance. You need to be part of the group because when it goes sideways, it's going to more than pay for itself. All right. My mother always says it's better to have and not need than to need and not have. And for insurance, no truer words were ever spoken. Okay. So we got to make sure that we're going to help people to, protect themselves against this risk. Because look at this question here. How many days do you think that you could survive if you stopped working today and you were sick? So not only do you don't got money coming in, but now you got all the expenses that are associated with being ill. Okay, fixed index annuities and life insurance policies are really strong contenders here because these policies have benefits built into them to kind of help with these situations. All right, so let's take a look really quickly at the life insurance living benefits versus, say, disability insurance. Okay, so disability insurance, that's not bad to have. You can pay anywhere from 1% to 4% of your income for disability insurance. Okay, but in this kind of little safety net, So it'll replace part of your income if you become unable to work, like you fall off the ladder or you got a physical job or whatever. But what a lot of people don't realize is that there's something called an elimination period at the beginning before you can claim the money in disability. Okay. Now, how much it pays out and how much you pay in, it's all these factors in there. How long are you going to wait? How long do you have to go without getting paid before you can start to make your claim? How long are you going to be able to get paid once it kicks in? Okay, that all varies in the price of the coverage. And then there's very specific criteria as to what qualifies as disability. Sometimes it has to do with what your job is, right? So let's compare that to the living benefits that are in a life insurance policy. So in a life insurance policy, a lot of the policies and the fixed index annuities have these strong living benefits built into them. So there's terminal illness rider, there's chronic illnesses, there's critical illnesses, okay? They're ones that are triggered if they end up with Alzheimer's disease or Lewy body dementia. I mean, this is a lot. These are these expensive things that don't kill you, but they can really wipe you out, right? And then the other thing that's really great is that we've got this ability that just say somebody doesn't get diagnosed with one of the specific things. So if you buy a specific critical illness policy, there are specific 10 yucky things that'll trigger it off. Well, what if it doesn't happen to be one of those, but you're in this position where you cannot do 2 of the 6 activities of daily living? That's what these little down here in the bubble, walking, bathing, eating, dressing, getting in and out of her bed, transferring. So if a person can't do 2 out of the 6, it will trigger the living benefits that are in these life insurance and fixed index annuity policies. And depending on the policies that we choose and the different parameters there, some of them will actually put a multiplier on the eligible cash amount at that point in time if there's a triggering event. So this plays very strongly into that principle. All right, life insurance and FIAs. And guess what? That's what we do all day, right? Life insurance and FIAs. All right, so I'm going to take a minute here, see if this is going to load in the way I want to, and I'm going to play a recording for you, a video for you, that talks a little bit about living benefits. Here we go. Not too long. Check marks all over everything. Okay, we turn this up a little bit.
I started losing movement in my hands and legs. I went from a cane to a walker to a wheelchair. We did not know what it was. Sure that I may have at best 2 to 3 years. For most American families, as they go through a health episode, at times it's not just the health, it's everything else as well that comes with it. And we were basically fighting different battles on about 3 different fronts. My faith, our faith, is central to everything that we do. If through faith we could make it through this, I knew that there was a larger meaning, a larger purpose. The financial benefit let me focus on healing and recovery and not having to worry about losing my home, kids being kicked out of college while I go out and get the care that I needed. Every adult needs to have a life insurance policy.
A good life
A good life insurance, and just not any policy. One with all the riders that we were able to take advantage of. It made us feel good to know that National Life was there for us when we're at our lowest. Because let's be honest, the odds were against me in terms of being able to actually rebound from this. And I just needed to know that the family would be okay. So where am I now? I do a lot of physical training and I'm getting stronger and stronger every day. I happen to serve as the executive director of a health association. We're celebrating recovery, but I will say this has been a tremendous journey of faith for us. There's such a power in love. I believe that us really going through this type of event brought us closer together. I would not trade it for anything in the world.
All right. Okay, so we see how important it is to have living benefits, right? I did recently see, you know how Biden signed all that stuff on the way out of office there a couple of weeks ago. He actually signed something that I hope it holds up that basically says that starting in March of this year, the credit bureaus, you know, TransUnion and Equifax, are no longer going to be able to count unpaid medical debt against people's credit scores. That's going to help a lot of people because, you know, once your credit score gets messed up, you know, you get all these financial issues and it's just a downward spiral, and then you got a chicken and egg with your bad credit. You can't get, I mean, the whole thing, right? So hopefully that will withstand the flurry of executive orders that's getting ready to come down from our newly appointed person over there. Okay. But it's super, super important. All right, let's get on to this last principle here. Okay. So Warren Buffett says we need to pay attention to nurse estate and the probate court system. So every estate planner, legal advisor, they are letting people know, look, you got to have your house in order. Okay, proper estate planning. So wills, trusts, medical directives, revocable trusts, all these things are critical to avoiding probate court. All right. So anything that's not specifically a specific name beneficiary, when you pass away, if you have any assets, the state gets to decide how those assets are distributed. And if your family happens to not agree with that, it could get very expensive. They could be in probate court for upwards of a year, fighting it and trying to make sure those things don't happen. So luckily we have great partners here like Net Law and stuff like that. We can help our people get their stuff in order. But again, fixed index annuities and life insurance are going to be solid choices here because every time we set up a policy, do we not name the beneficiary? Right? We're naming the beneficiaries. We're naming the contingent beneficiaries. All right. So it's very important when we're choosing those beneficiaries, but that means that those things are not going to get caught up in probate court. And then the other thing that's super important here is this idea of being protected from your creditors. So I'm going to use an example here. Hope I don't get myself in trouble. I'm going to use O.J. Simpson. Now, look, I don't care if you think he did it or not. Okay? When Nicole's family went after O.J. Simpson, they cleaned him out down to his Heisman trophies. Okay? They went after for one, sooner or later, he was over there sitting in the jail, right? But guess what? When he was sitting in the jail cooling his jets, okay, the money that was in his life insurance policies and in his annuity policies, they could not get at it. Okay, so if you ever wonder how do these rich people do all this stuff and then they get sued and then they keep bouncing back and why aren't they sitting over here on Skid Row with the rest of us? They have life insurance people. They have annuities set up and those monies are protected from creditors. So this can be a really, really, impactful thing there. All right. Let's wrap this up here. So let's look at everything across the board. When we line them all up, we can see that life insurance is the clear winner, with fixed index annuities coming very closely behind it. The good news is that your life and health license, that 215 license, puts you in a position where you can work with both of these, the FIA and the life insurance every single day. All right. So if you're wondering, did I pick the right place? Did I pick the right career? Is this something I can do? Yeah, this is where the money is, folks. All right. And you can help people. So the nice thing about being at Experior is that we have the flexibility to find the right fit for anybody, no matter what they come to us with. We've got all these insurance carriers. I think Sean said we had 88 partners in the United States the last time I was in a meeting with him. So we've got referral partners, we got Net Law for the probate and the wills and the medical directives. We got people messed up with their credit. We got the debt medic. We can help them with their Medicare. If they got a messed up credit score, we can help them with that. If they're overpaying on their business taxes, we can send them over to Excel Empire. We've got all of these options so that no matter where our people are, we can meet them where they are. And your answer is always going to be, I can help with that. All right? But how do you know what's going on? You got to do a green sheet. Everybody gets green sheet, right? When we do the green sheet, we get a full picture of everything that's happening. So here's some recommended reading for you. Okay, these first two books, as you move through the blueprint and you go in that session with Dr. Mary, you move through the blueprint, you're going to find these both two are linked into the paperwork there. Nice, easy reads, but it really helps to put everything in place for you. Okay, so we need to always be learning. Always be learning. All right. So looking at some of the content in the first book there, did you know that major corporations and the wealthiest 5% leverage life insurance as a financial tool? We already talked about how O.J. Simpson didn't have to give up all his money, right? So wealthy people leverage life insurance. And so do the banks. Okay, so let's do a little, so this is hundreds, thousands, millions, billions with a B. Okay? So if Bank of America and Wells Fargo and all these banks have their money, a lot of money tied up in life insurance, what does that tell you? Life insurance is a tier 1 asset, capital asset. So money is ranked from tier 1 to tier 5. Tier 1 being the safest, tier 5 being the riskiest. So if life insurance is a tier 1 asset and these banks got their money in life insurance, you should be thinking, why are they doing that? Right? And then you want to look back and say, oh, look at all these businesses. They got their money tied up in life insurance too. You're going to read some stories in those books on how life insurance saved some of these businesses during the Depression. When they couldn't get money from anywhere else, they were able to borrow against their life insurance. Okay? The last book talks about the family banking strategy, but I want to focus here. You guys should know who Ben Bernanke is. He's the former Federal Reserve chairman. He's got a lot of his money, liquid money, invested in insurance products that have guaranteed so these rates of return. And my point is, if it's good enough for Bernanke, it should be good enough for us, right? So let's come back around. Let's pull it back around to Mr. Warren Buffett here for a minute, okay? He is the greatest investor in insurance companies. His current net worth right now, guys, this was January 2025, right now, $141.7 billion with a B. And guess what? Most of it was accumulated after he was 65 years old. So if he had retired at 65, we wouldn't be talking about him. I think he only was worth like maybe 10.7 billion at that point. Only 10.7. Okay, that would have been in 1995 because I think he was born in 1930. So what Warren Buffett says is, when it comes to like compound interest and investing money and stuff like that, that you got to think of it like a snowball rolling down the hill. The trick is to have a very long hill, which means starting very young, or living to be very old. He's getting kind of old, right? Okay, but we need to get that snowball going and roll it down the hill. So if you think back about the $1 Million Baby concept we were talking about earlier, you can put a small amount of money in there. The hard part is getting that snowball going, right? We just got to put it on that hill and we got to roll it down the hill. Okay? So look, it is said that you can't go back and change the beginning, but you can start from where you are and you can change the ending. So what I want you to think about today is, can you imagine if somebody had introduced these concepts to you when you were younger? I'm a little older than some of y'all, and I can just tell you that if somebody had introduced these concepts to me 25 years ago, I can only speculate on what my life's path would have looked like. And what I'm saying is, by your decision to come here and grow this business, you have put yourself in a position where you have the power to shine the light for these people. Okay? So don't put your light under a bushel. Get out there, talk to people about what we're doing, grow your teams, learn your craft. All right? So Mr. Ben here says, if you think education is expensive, try ignorance. Because it absolutely is. And the last time I checked here in the United States, being poor is expensive. It's very expensive. Okay? So we need to help people do better. So what's the next step? You ready to take control of your financial future? We're going to create a customized confidential plan tailored to your goals. We're going to set you on that path to financial freedom. You're going to see how it works for you, and then you're going to turn around, we're going to replicate it, and we're going to do it for everybody else. So that's all I got for you guys today. Thank you so much for listening to me. I love working with you guys on this kind of stuff. As you can tell, I'm a little bit passionate about it. Let me take a second here and
Awesome job.
yep, I'm
You
trying
did
to
an awesome job, Leah. Awesome. I love your passion. And you and I are like sisters.
yes,
This is
yes,
this
yes,
is
yes, yes.
this is where it's at.
Absolutely. I'm trying to figure out how to stop this recording. I hope it's recording.
On the top, click on the recording
I know. I'm not
and
seeing.
it should give you options
Oh,
to
there it
stop
is.
it there.
There it is.